Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Welcome to another APLD analysis. This time, we will analyze the company stock from different perspectives. We're talking about Applied Digital Corporation, or APLD, which has made, one of the most remarkable and high-stakes pivots I've seen in the digital infrastructure space.
They've gone from being a pretty simple crypto hosting provider to what they now call a pure-play developer of next-gen AI factories.
Yeah, and that pivot, while it's definitely secured some headline-grabbing contracts, it has also turned APLD into a definitive battleground stock. You have this fiercely bullish camp calling for multi-bagger returns. We're talking 5 times the current value, and they're standing right opposite a very large group of investors betting heavily that this whole thing fails. The split here is it's extreme. It really needs a closer look. It absolutely does. And the central question for anyone trying to figure this stock out is this: does the powerful structural setup, and that includes an $11 billion contracted backlog and a massive short interest, does that guarantee a huge re-rating? Or do the fundamental problems, and we're talking about relentless dilution, big execution risks, customer concentration, do those just negate the whole growth story?
Well, I'm firmly in that second camp. I think the execution risks are just too high, especially when it comes to financing and, getting the utility companies to deliver on time. All of that, in my view, fundamentally undermines those blue sky valuation targets. The share price today already assumes a level of perfect execution that is frankly still years away from happening, if it happens at all.
See, I have to challenge that. I look at APLD, and I see a deeply constrained, very scarce asset in a world that is absolutely starving for power, especially power suitable for high-density AI. It seems to me it's structurally primed for a valuation recalibration just based on the strength of its contracts. And what's more, the technicals of the stock with that huge short interest, well, that suggests the market is set for a violent correction upwards. Okay, so my bullish case, it really hinges on the economic moat that APLD has managed to build. And I'd argue it's not a financial moat, it's a physical one. It's all about time to power and power density. They've built these purpose-built liquid-cooled facilities, the AI factory architecture, and they're designed for densities of, 40 kilowatt up to over 100 kilowatts per rack. That is a massive technical advantage when most older data centers are struggling to even hit 10 kilowatts. And the proof is right there in the contracts. You have an $11 billion plus backlog, headlined by that landmark 15-year CoreWeave lease. That's 400 megawatts valued at $7 billion, and then another 300 megawatt deal with a big investment-grade hyperscaler. So that validates the assets, and it shifts their whole risk profile toward predictable, almost commercial real estate-like revenue. And critically, and this is key, you have to look at the stock's technical setup. The short interest is sitting at an incredibly high 30 to 33% of the free float. That's over 80 million shares shorted. That's not just skepticism, it's a dangerously crowded trade that's basically engineered for a massive pain trade higher on any good news.
That backlog data is compelling, I'll give you that. But let's talk about why 80 million shares are being shorted. This isn't irrational. The bear thesis is centered on APLD being a capital incinerator. They have these massive CapEx demands to get those facilities running, and that means they perpetually have to raise money. And this feeds into the real silent killer here for shareholders: dilution. We've seen the share count just explode from around 114 million in 2024 to potentially over 279 million by late 2025. That's more than 100% dilution.
Right.
So even if the company achieves a phenomenal 5x market cap return, existing shareholders might only see a 3.3x return on their share price because of that constant expansion. And then there's the huge execution risk. Those aggressive timelines for projects like Polaris Forge 1 and 2, they are completely dependent on the slow, bureaucratic process of getting grid interconnection from regional utilities companies like Montana Dakota Utilities, which can cause months of unforeseeable delays. So the valuation disconnect is it's staggering. You're talking about a $6 to $8 billion valuation resting on trailing 12-month revenue of only $144 million. That disconnect gives short sellers a perfectly sound reason to be betting against the stock until every single megawatt is up and running.
Okay, let's start the debate right there. Where the stock is most vulnerable to a violent move, that structural imbalance from the short position. You say the shorts are rational, but the sheer volume, 80.3 million shares, that represents this huge inelastic demand that's just waiting to flood the market on a technical signal. We need to dig into the free float dynamics to really understand the mechanics of a potential squeeze.
I agree the technical setup is unusual. I do. But I really question whether that setup can overcome the constant supply of new equity. Why should that technical floor hold up?
Because the effective tradable float is much smaller than the official number. The share float is around 256 million, sure. But big institutional long-term holders, Vanguard, BlackRock, funds like Hood River, they're buying and holding massive positions. When passive institutions hold stock, those shares are far less likely to be lent out for shorting, and that creates a supply crunch for people trying to cover. This is reflected in the extremely high cost to borrow the shares, which itself puts constant financial pressure on the short sellers. Every single day APLD doesn't fall, those borrow costs are eating away at their thesis.
Okay, but the high cost to borrow just reflects the high perceived risk of a squeeze. The shorts are paying that cost because they believe the risk of execution failure is even higher. And besides, the days to cover ratio, while it's respectable at around 3 days, it's not historically catastrophic. To really trigger a squeeze, you need forced closing of positions, margin calls, lack of shares to borrow. And the fundamental reality here is that APLD has shown, time and again, it will issue equity to fund its growth. This constant supply of new shares counteracts any technical pressure. Every time a short is forced to cover, the company could just step in and issue new shares, effectively replacing that covered short with a new unit of float.
And that's where the trading analysis becomes so important. We're seeing evidence, especially from looking at dark pool trading, of this persistent, high-volume selling in those off-exchange venues. It reflects a very intense, very sophisticated shorting campaign. But if the company hits its key energization milestones, that catalyst flips. The shorts face margin pressure, and all that dark pool selling, it dries up instantly. They aren't just betting on delays, they're betting on a catastrophic failure to justify the cost and the risk they're taking. But that $11 billion backlog provides a fundamental floor that makes catastrophic failure seem less and less likely.
I'm just not convinced that floor is as solid as you think, which brings us to the second point, the path to that valuation multiple you need. The so-called holy grail, the REIT conversion, is absolutely necessary to get those high 25x or 30x EV/EBITDA multiples that peers like Digital Realty get. But why should the market give a developer a stabilized REIT multiple when its financials are fundamentally unstable?
Well, the valuation recalibration will happen precisely because APLD is transitioning its financial profile. You're focusing, and you're right to, on the high debt and the immediate problem of negative GAAP EPS.
And that negative GAAP EPS isn't trivial. I mean, building data centers by its very nature creates massive front-loaded depreciation charges. So even if APLD is generating strong, positive operating cash flow from its contracts, those non-cash charges drag down the GAAP earnings. It makes them look unprofitable on paper for years, which complicates their debt financing and managing debt maturities. It really gets in the way of achieving the stability they need for REIT status.
That's a very accurate description of the accounting challenge. But the market, especially the real estate capital market, it looks past GAAP EPS. It looks to adjusted funds from operations, or AFFO. The REIT conversion isn't really about fixing profitability. It's a financial engineering move to allow for capital reallocation. By becoming a REIT, they can distribute cash flows stripping out that non-cash depreciation and open the floodgates to real estate funds and generalist investors who can't invest in non-REIT infrastructure. Those 15-year fixed contracts make APLD look like a long-term commercial real estate leaseholder, almost a bond proxy, which justifies the comparison to a Digital Realty. The market isn't pricing the current CapEx burn. It's trying to price the long-term, stable return on those future assets.
Okay, I accept that AFFO is the key metric, but the ability to even do the REIT conversion depends on successfully managing the customer concentration risk, which is my biggest concern here. Let's get to point 3. They secured CoreWeave, which was a huge win, but being so reliant on CoreWeave for a majority of your revenue, that's the single biggest operational risk factor. CoreWeave is a fast-growing startup, not a decades-old investment-grade hyperscaler. APLD is basically taking on the solvency risk of a single tenant for 15 years on a highly specific, purpose-built asset.
The risk is there, I won't deny it, but diversification is already happening. That 300 megawatt deal with the investment-grade hyperscaler is critical risk mitigation against a CoreWeave failure. But again, the real value here is the underlying physical asset and the arbitrage from the grid connection. The value is the infrastructure itself. Grid bottlenecks all across the US and Europe mean that any competitor trying to build new gigawatt-scale AI infrastructure is looking at connection timelines of 3 to 5 years. APLD has already secured power in places like North Dakota. They're offering power now. That time advantage is the moat.
That time to power advantage is undeniable. I agree. However, the pace of AI hardware innovation is just blistering. We are constantly moving to new GPU generations, from H100s to Blackwell and beyond. What happens if future chip architectures need dramatically different cooling systems or rack designs that make today's liquid-cooled facilities obsolete faster than the 15-year lease term? APLD is taking on real estate risk, the risk that their asset becomes technologically outdated or that the tenant just defaults.
I think you might be overstating the technological obsolescence risk there. Liquid cooling architectures are, by their nature, more flexible than older air-cooled designs. But more importantly, the power they deliver is fungible. If CoreWeave needs different racks in 5 years, the underlying megawatt capacity and the proximity to the substation, that remains the most valuable and scarce component. They're selling location and power rights, not just the steel frame.
And yet we see peers like Iris Energy who take on technology risk. They actually own the GPUs, but they operate on much shorter-term power contracts. APLD's model is the landlord model, which should be very defensive. But the high customer concentration with a scaling startup, it introduces this venture-like element to what should be an infrastructure investment. The stock has to justify its premium multiple by proving that the CoreWeave contract is truly as safe as a bond and can withstand unforeseen technological or financial problems.
Which ensures APLD can keep financing and developing new capacity based on proven demand. Look, APLD presents one of the most asymmetric risk-reward profiles out there in the public market right now. The path to a 5x return is incredibly narrow. It demands flawless execution, successful utility delivery, and the sophisticated financial engineering for a REIT conversion. But that path is visible. It's grounded in the market eventually recognizing the annuity-like quality of that $11 billion backlog. And critically, that aggressive short position, over 30% of the float, introduces a powerful mechanical force that could front-load those returns through a violent technical squeeze.
And I still maintain that this stock is a vehicle for high-conviction investors who are willing to accept what is essentially venture-like risk in a public stock. The whole thesis requires them to perfectly navigate financing, construction, and utility delivery over years while minimizing the damage from constant dilution. The current valuation already embeds so much future success. It demands something like $1.4 billion in annualized EBITDA. Any substantial slip-up, a 6-month utility delay, a failure to get the reconversion done quickly will punish anyone who ignored the very rational bearish arguments about capital needs and concentration risk.
Ultimately, the material gives strong evidence-based arguments for both a blue sky scenario, if that time to power moat holds and execution is perfect, and, for substantial downside if the operational timelines falter. The investment decision here really requires weighing those powerful short-term technicals against the very daunting long-term fundamental hurdles.
Right. Understanding both the severe technical pressures creating the volatility and the structural financial pressures that will dictate long-term success is essential to making an informed decision on APLD.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.